I received an email today from Jim Cramer, and guess what he told me? He told me that, according to Morgan Stanley research and analysts, Apple is now most under-owned large cap US tech stock, and Meta Platforms, Meta is the most over-owned. So those are the two stocks I want to pull up. We're going to go down and look at the rest of Cramer's recommendations and stocks he talks about here, but let's pull up Apple and Meta first. So we're going to flip over to track and trade. And let's look at these two stocks together. These are two stocks that Cramer mentioned in his newsletter. As you know, Cramer is a fundamental analyst, and he does a very good job at fundamental analysis. Although there are a lot of people who laugh at Cramer, and there's even a company out there that fades Cramer. They trade everything just the opposite of what he says to do. So I think that we need to meld both fundamentals and technicals together. Cramer is very much a fundamental analyst. I'm very much a technical analyst. But when we put those two together, I think we have a 1-2-3 knockout punch, as we like to say, right? So if you get some fundamental information or some fundamental news, reports like earnings or all kinds of news about the operations of the company or some taxes or, things that can affect the company that come out with a new product or government reports. Those are fundamental things. So those are all great and wonderful. We need to know those. The fundamentals drive the long-term trends, but we also need the technicals. The technicals are the mathematical models, the trend lines, the Fibonacci's, the Elliott waves, those types of things, which have us help us with setups and triggers for entry so that we know when to get in or when the right timing is to time the entry of those fundamental trends. All right, so I believe you have to put the two together, and that's how we decide when it's time to enter these fundamental runs and moves. So if Cramer's going to say, hey, it's time to buy something, I'm not going to jump right in and buy it just because he fundamentally thinks it's a great opportunity. I'm going to go and look at the technicals, and I'm going to see where is the setups, where's the triggers, where is a reason for me to enter. I like to buy low, sell high. Other guys like to buy high and sell higher. I'm not a real fan of that strategy. That's a difficult strategy. So I'm more of a buy low, sell high guy. I'm going to wait for markets to dip down into low regions where they're generally because they're having bad news. So we're going to buy a lot of stocks that have bad news, and that's how I've made, my best money is buying stocks that have been beat up. Who was it? Rothschild, who once said, buy, when there's blood in the street. So I like to buy low. I like to buy when the bulls and bears is in the red zone. Now, Apple is definitely in the red zone, but it's also, I like to follow Elliott wave, and I also like to follow the Richard Wyckoff theory. Now, if you're not familiar with Elliott wave, Fibonacci, Richard Wyckoff, the red zone, buy low, sell high, blood in the street, I have a book that you can buy. It's on Amazon. I tried to keep it as low price as I possibly could. Search Lan H. Turner. It's 280 pages of all these wonderful things that you need to know about trading. Sounds like a lot, but there's lots of pictures, lots of examples, and lots of charts. And it'll show you what the Elliott waves are, the Richard Wyckoff theory, the Fibonacci, how to use them, what the setups, the triggers are. It's a great book for that, and it's how we're going to read these charts so that we can get the technicals and the entry points for the fundamentals. So Apple, take a look back at the chart. So this is Apple, the most least owned. And what we are is we're coming into what looks like to me it's an X1SA1. What's an X1SA1? It means it's the first exit to the short side, and if it was to turn and rally, it would be the first A1 to the long side. So that's why we call it an X1SA1. X1S, first exit to the short side, so that means that this would be your entry right here to the short side. So that'd be your A1 entry to the short side. All right, so your A1 entry to the short side, come down, and when it hits those blue lights, that would be your first exit. Get out, take your profits. So X1, so your first exit to the downside of the A1 downside potential, but it's also, the market could take off and go from here, right? It could go up like this, so if that's the case, that would make that an A1. So we call it an X1S, X1 to the S short side, A1 to the long side. And the reason that's important is you're like, oh man, you're getting too complicated on me. No, it's real simple. All we're doing is counting drives. A drive, B drive, C drive. And then we have X1, X2, X3. So we have X1 out of the A drive. We have X2 out of the B drive. We have X3 out of the C drive. This is all outlined in the book. And the reason why that's important to know and understand is because markets have a tendency to make 3 drive patterns, right? That's the Elliott wave. 3 drive patterns, A, B, C, D, A, B, C, D. Just two ABCs in a row. It's real simple, not real hard, but that's all outlined in my book. And the great thing about that is that those things tell us the probabilities. Because we know from lots and lots of history in the past what the probabilities are of these different X1s, A1s, B1s, C1s. We know what the probabilities are. So we can go through and we can look at this, identify it, say, hey, that right there is an X1S A1. We look it up on the table, X1S A1. It's like when you go to the casino and you got these little cards, right? You know, the little cards that tell you what all the probabilities are, and you play the probability cards. They even let you take those cards to the table with you. You can set it right there and say, oh, I've got a king and an ace. Probability, oh, they've got probability is really high. I think I'll play this. All right. The same thing. That's what we've got in that book. In the book, there is a whole series of pages that show you the probabilities. What's the X1S A1 probability? You look it up on the table. Oh, pretty low. Not a very good trade. Don't think I want to risk it. So that's what this is X1S A1. And so not a high probability. Doesn't mean it can't go. Doesn't mean you can't win with a 3 and a 2. You can still win with a 3 and a 2 at blackjack, but the probabilities are pretty low that that's going to happen. So that's what this is. This is an X1SA1. Probabilities are really low that this is going to rally and go up from here. Not that it can't, just that it's really low, and that's the probability says that we're going to get an ABC pattern. So an ABC, down we would expect it to go. And if this is the distance that it went the first time, once we get the retracement, we would expect it to go the exact same distance. Again, not the exact same distance, but something close, right? It's called the volatility scale, and this is what we're looking for. We're looking for a reflection of the first volatility scale into the second reflection. Now, does it have to happen? No, nothing ever has to happen. We can take a Fibonacci ruler off of this drive, and that would put us back down. You can see that this thing came down and touched the 50% level. Now, that's telling you technical analysis. Look at that, right down to the number. That thing came down and touched that 50% level off of that last move from top to bottom. So that big long green drive came down and lost, look at that, 50% of everything it made in the last 1, 2, 3, 4, 5 months. It took 5 months to get up there, and it lost 50% of it in about 3 weeks. 2 weeks. Isn't that ridiculous? Don't be afraid to take profits. That's why we need to know what these blue lights are telling us. These blue lights are telling us these are probabilities that we're going to get into a bad situation. There's another one right there. There's another one right there. There's another one right there. Okay, these little blue lights come in here and they tell us where these markets are going to break. Now, we generally anticipate 3 of these blue light sections in a row. Drive 1, drive 2, drive 3 is what we call them, 3 drive patterns. So we expect it to go up, break the blue lights, go up, break the blue lights, go up, break the blue lights. And the third time it breaks the blue lights, we don't want to go long anymore. Again, it's the probability table, that little card that we're playing. That little card probability table tells us not to go long at the top of the third drive, because that's where we generally get that big sell-off. You want to go short, buy a put. That's a great idea. That's something you can do. Most of the times we don't get a 4th, 5th, 6th drive. Probabilities tell us we don't get 4, 5, 6 drives, but it doesn't mean you can't. It certainly can. Okay, and each time you get a higher and a higher, you get a 4 and a 5 and a 6 drive, well, the likelihood of those things continuing and making big long moves is pretty slim, so we're going to probably get a bigger drop. So that's what we're looking for here, and that's what's happening here on Apple. And that's just a quick summary of what you're going to see in the book. Now let's go look at Meta. And Meta's given us this just another massive long drive. So here we go with drive 1, drive 2, drive 3, drive 4, drive 5, drive 6. That's the most unbelievable drive. I've never seen anything like it before in my life. This went nuts on us. But you see the drives, you can count them in there. So each one of these little short sets of drives are buy signals going into the next long set of drives. So we call it a long set of dots followed by a short set of dots. Long set of dots followed by a short set of dots. So when you're in a trend like this, you follow the long set of dots and then you anticipate a break. Get the short set of dots, which is the counter trend, and then the long set of dots represents the trend. The short set of dots represents the counter trend. The breaking of the counter trend is an entry signal for the long set of dots. And you'll notice at the top of the trend we got the bulls and bears Fibonacci sequence, which is telling us this is the end of the long drive and this is the beginning of the long drive. So everything in between is the Elliott wave patterns being counted by the bulls and bears. Bulls and bears is what's turning the price bars red, yellow, and green. It's also what's giving us those blue lights, which counts the drives of the waves, and it's also what's giving us the starting of the Elliott wave and the ending of the Elliott wave. So that bulls and bears system is really super important when it comes to trading if you understand it, if you know what it means. We're not just buying every time we get a buy signal, sell every time we get a sell signal. That's not what that means. That's the beginning of the Elliott wave and it's the ending of the Elliott wave, and the drives are counted in between. All right, so we count them. We end up knowing what the probabilities are. As we get higher up into the drives, the probabilities continue to go down. So that's the name of the game, right? So right here on the reversal, we're starting a new drive down because it's starting to roll off the top. We're going down, and that's why it's the first drive. And on the first drive, we don't expect it just to V and recover. It could. Again, it's all probabilities, but we expect it to make that ABC down and retrace down, and that's where we want to be a buyer. Buy low, sell high. All right, so that's meta. Let's go over and see what else Cramer's talking about over here. Next thing he talks about is Foot Locker. Now he says Foot Locker is a disaster. It's falling quarterly sales, guidance cut for the second time this year, and so it's down seriously. Let's go over to Foot Locker, FL. So here's Foot Locker, and you can see it dropped like a rock. Okay, so it came down off of this this nice flat narrow sideways channel, and rather than breaking higher, it tanked and went out the bottom. Now I like to buy low, sell high, so this is a stock I will put on my watch list because Foot Locker will eventually recover. They will start to increase in value, and I will have bought when they're really suffering, when there's blood in the street. I don't like to buy high and sell higher. I like to buy low and sell high. So when these things come down, now am I going to start buying today? No, I'm not going to start buying today. I'm going to wait for a pattern, some sort of a technical setup. I want the blue lights to come in. I want an intercept order. I want, a pattern like look back in the past. I want something like this. I want something like this. I want something like this. Okay, these are the patterns that I like to get into as markets rebound off the bottom and start to rally and go back up. So long set of dots followed by a short set of dots, long set of dots, short dots, long dots, and then we get 3 of those in a row. There we go. Look at that. Right straight out of the book. Drive 1, drive 2, drive 3, ABC top down into the red, and away we went. And then this thing started to lose momentum off the technicals or off the fundamentals. We got the 3 drives right there, what I call the spider web. Again, the spider web, that's documented in my book, so you can get that and learn about the spider web and then how that thing drops and cascades down. And we'll look for the reversal and the time to start getting into that thing, and we'll start looking to buy Foot Locker. All right, so let's go and take a look at the next one. The next one he says is Peloton. I'm going to skip Peloton. It looks almost like Foot Locker. I don't much interested in Peloton. Actually, let's go look at it just because it's a PTON. It's a very inexpensive stock. PTON. It's $5. And so if you're looking for a stock that has nice movement in it, it does have nice trends, and it does trend well. So you can see a nice drive 1, drive 2, drive 3, long sets of dots, long sets of dots, long sets of dots, short sets of dots, short sets of dots. We get down to the bottom of the 3rd drive, and it started to go sideways, and then the fundamentals kicked in and said this market's really struggling worse than we thought, and down it goes again. So it's cascading. All right, so here we had, let's slide back and see what we got here. We got 3 dots, real ugly ones. Drive 1, drive 2, drive 3, reset, and then we got one big long drive there to get to the top. But this thing's had problems, but it is only $5, and it's been as high as 18. So if you're into a $5 stock and you want something that you can work with a smaller account, hey, Peloton might be just your thing. So let's come in here. It is down low, buy low, sell high. So we're coming in here. We're going to go to Dick's Sporting Goods. So the sporting good companies, Foot Locker had problems. Dick's Sporting Goods. Now Dick's Sporting Goods, he says, which saw shares plunge 24% on Tuesday and drop nearly 2% early Wednesday. He's not very bullish on this market, but I want to show you something. Why I am. Let's go look at DKS. DKS. All right. So look at DKS. Oh, this is not the one I'm bullish on. Sorry. But this one here, Dick's Sporting Goods, is wow. It just it tanked. So I forgot that this one did that. So this is the one that look at this thing all the way down. So they really had a bad day. Bad day of it. They're coming down. These are the areas of support that we have to look for this thing. So it came down, touched the support. We might get one more support down here and test this other support level down in here with Dix. And there's no telling how far down it can go. We could start looking at weekly, monthly charts. You know what? Not to rag on this store, but I never go in there. They're the Dick's. Well, I'm not going to say any bad thing bad about them. You know what? I don't like stores that have to compete against Amazon to survive. I never have. I've always said if you're competing against Amazon, you are in an uphill battle every single day. And Dick's is a really expensive store. So anyway, let's move on from Dick's. All right, Kohl's. Let's go into Kohl's. KSS. Deliver second quarter earnings and revenue beat. Maintain full year numbers. Shares get a bump. Okay, this is the one that I think is actually let's go look at this. Better story than Macy's, which warned and saw its stock tank 15% on Tuesday and slide modestly early Wednesday. So let's go look at KSS and M. So there's Macy's coming down here. Again, it's one of these stores that retail stores, and I'm not a big retail store fan. I don't buy a lot of retail stores. So there's drive 1, drive 2, drive 3 right off the top. It went sideways. We got drive 1, drive 2, drive 3, and it broke right there. So, look at those bulls and bears arrows. Those are telling you the start and the end of the Elliott wave patterns. Not all markets move through perfect Elliott waves. It's just, again, it's a probabilities game that we're playing here. And so we're looking for those 3 drive patterns. Once the market gets into the trend, we want to see those 3 drive patterns. We want to see them start and end, and then start and end. Notice the starting point here to the downside, the ending point, that's the start to the upside. This is the ending point, start to the downside. And again, look at this. We got a start to the downside, and it turned and started to the upside again. So it's not like every single market moves through these perfect Elliott waves, but for the most part, you can find them time and time and time and time again. So that's why we use them as our primary functional base. It's kind of like the foundation of a house. It's the foundation of trading. Are these patterns like this? So let's go look at Kohl's. Kohl's is the one that I think I'm a little bit more bullish on, and the reason is because why? Drive 1, long set of dots. Drive 2, short set of dots. Drive 3, long set of dots. Drive 4, short set of dots. Now, the problem is that this one went up, broke the short set of dots, anticipated a rise, turned and fell back down and broke the short set of dots. So we're kind of in this what the heck is going on zone right now. But I am bullish on this market. I do think we're going to try and make another drive. This shows a little bit of weakness. It should have continued from this drive here. It shouldn't have come back and fell back like that. But there's some fundamentals that are in play right now. And so I think we might see a recovery and see this thing go up and try and make a third drive. Now, are you excited about getting into a third drive? Well, it's not a very high probability of success. It's the third drive, and the higher drive, the more drives you get into. The biggest drive, the where we make most of our money, is in that B drive. The A drive we oftentimes miss because we don't know when it's going to start the A drive. So the A drive could start at any point. The bulls and bears comes in and tries to help us, but we don't know how long that A drive is going to be. Makes that first ABC off the bottom. We look for head and shoulders formations, and you can watch in some of my other videos or in the book where I show you how we kind of track that down and try and figure out where that low point is going to be, that what we call the Wyckoff spring. And then that thing takes off. So we oftentimes will miss the A drive. So the big money maker is that B drive, the second drive. And then we can try and, as long as we're in, we still have some money in there, we can go and try and make that C drive. I'm not a real fan of trying to get into the C drive as my first entry because it's a low probability, although, it generally likes to go, so there's an opportunity there. That's one of your buy high, sell higher opportunities going into that C drive, or that third Elliott wave pattern drive into the topping formation. So that's what we're looking at here on Kohl's. If an Elliott wave is going to fail, it generally fails trying to make a third drive. So we generally get 2 drives, ABC, and we don't get that other ABC, that up into the D pattern. So that's just a little bit of insight there going into Kohl's. So let's go back and see what else he has to say quickly. Goldman Sachs ends Summer Friday saying it wants employees back in the office 5 days a week. The mandate comes as CEO David Solomon has been under pressure recently over consumer banking problems, criticism about his leadership style, and his hobby as a DJ. He's not been spending a whole lot of time on Goldman Sachs. He's not really dedicated to the job. He goes off and goofs off and does all this other stuff. He's let all of his employees go on Fridays. They don't have to work on Fridays. And so he's been getting a lot of criticism lately. And, let's go look at his stock. So that's his stock, and you can see it's just not been doing a whole lot, and he's been getting a lot of criticism for it. I actually did pretty well because I bought his stock right down in here and rode it all the way to the top and sold it up here. But, good thing I did too, because look at how it's tanked. So he needs to get his company back in gear. Goldman Sachs, get back to work. Get those people back on their desks on Fridays and get out of the dance floor and get up there in your ivory tower and start driving your stock back up because your company's suffering. That's what everybody's saying. I'm saying it too. All right? Get your butt in gear. Let's make some business. Let's make some things happen. Goldman Sachs. But for us, hey, maybe he's going to turn this thing around, right? So we're going to look for some buy opportunities for Goldman Sachs and see if he can't turn his little company around. And when this thing gets down here, it starts to bottom out, give us some patterns down in here, we're going to start to look to start accumulating some shares and see if he can't turn his company around, get people back to work. All right, Goldman Sachs. So Amazon retail margin has legs, and AWS cloud unit is turning corner according to Loop Capital. The analysts raised the club stock price target to $200 a share from $180. Let's go look at Amazon, because Amazon is one that I talked about before, right? If you go look at my video from before, Amazon had this big rally on earnings right here. And I said, be careful. Be careful with that bar right there, because I said, if you look back in time, look what happened when we had another big bar like that. It happens, okay? You get big, huge, long rallies like that. Everybody wants to jump in and, oh, Amazon, we all love Amazon. Let's all jump in. And then you get your hind handed to you. So that's what I said. Be warned on that one. I did not get in on that big break right there because, first of all, it's buying high. Amazon's up there. I love Amazon. I would love to be in some Amazon. I'd love to have me some Amazon stocks. But it's gone up into the big multi-drive pattern 3. It's up there at the top. It's making all kinds of noise. I don't like to buy high and sell higher. It's a hard strategy. So this thing broke those blue lights, and I came in and I told everybody in that video, go back and look at my last video. I said, be careful. I'm warning you. Look what can happen with Amazon when you get a big bar like that. That thing will sell off and it's coming back down. Now, if you want to buy high and sell higher into Amazon, right now would be a time to start adding a few shares because it has pulled back off of that big rally, and it was good news. The reason it rallied was because it had good earnings. So now we could probably start buying some shares on Amazon as we got this little pullback down into the neutral zone. I'd like to see one green bar, as we break out and indicate that the market's starting a new Elliott wave and get that new start. But, starting a new Elliott wave at the top of an Elliott wave is not generally what happens. Usually we get some kind of a, profit-taking blow-off. These big companies like Goldman Sachs like to wait and have these things come in and buy down here in these regions here off of this Fibonacci retracement. Even though this thing has great earnings, it's up there. It needs to come back, digest a little bit. I would rather be a big buyer down in here. This is where I want to buy Amazon. Of course, we may not be able to have that opportunity. So if you want to kind of start teasing a little bit of 1 or 2 shares in here and start getting some momentum on this stock, then you could do that right now if you wanted to. It's a little tough right now. This looks like a head and shoulders formation to me. Left shoulder, neckline, head, neckline, right shoulder, break, and then that's where we get that break off that right shoulder down, right? So who knows? It could take off, make a V recovery, and go to the moon. But the probabilities, as we talked about before, we're going to look at our little probabilities card. Probabilities, no, very low. Okay. So next one. Salesforce, summer of stabilization and artificial intelligence center stage, stay bullish, stays stifle. He likes Salesforce, CRM. Let's go take a look at it. And if Cramer recommends Salesforce, a lot of people are going to go the other direction. Now, we have to come in and take a look. Once again, drive 1, drive 2, drive 3, drive 4. And now it's coming down, giving us this little zone of reprieve. Notice down here, look at the chalk and money flow. We've talked about that. If you're not familiar with that, go back and look at the previous videos or send me an email. I'll get you some information on it. We've talked about the chalk and money flow. Got a couple of wonderful students, good friends of mine who like to use this one, so I've been using it a little bit more lately, try to explain how it works, why it's in track and trade. It's part of the accumulation distribution model. It tracks. It's green down there because who's buying right now? The big institutions are buying. That's why it's green. So you look at it and you say, hey, wait, why is it green and going down? Why is it red when it's up? Well, that's because that's who's buying, who's selling. Chalk and money flow kind of tracks the large investors and the momentum of where they would be buying and selling. Right now, they're buying because the market's going down, right? They buy. When we buy, when we're buying, buy, they're selling. Somebody's got to sell to us when we're buying in the nice big uptrends, and we're buying all the way up the big uptrends. Who's selling it to us? Well, it's the big banks because they're selling out what they bought when it was going down into the red zone. That's what Chalk and Money Flow kind of points out to you, that hey, the big banks are buying right now, and then when we buy, when it starts to rally, they'll be the ones who sell it to us because got to have sellers for every buyer, right? If we want to buy, there's got to be somebody to sell it to us. So that's what's happening there, and that's how that works. And so now what we're looking for is this again. This is that very low probability because it's an X1S A1. X1 to the downside because, well, technically speaking, you would have got in right there to the short side. So that's your entry to the short side. So you're short. And then where do you get out? Well, you get out when it crosses that blue light. So that's your X1, first exit to the short side. So X1S. Now it's going to make a little ABC pattern in here. And we expect it to come up, break the blue lights, and then turn and fall once again and come down and make that A, B, C, D retracement off the back side. If we come in with our Fibonacci ruler all the way from top to bottom, that says that we should see this thing come down with these Fibonacci projections. 50% would be right down here, 61.8 projection, so the sweet spot's right here. It would be nice for me, I'd like to see Salesforce come down and be right down in here around this 50 to 61.8% level, and it says right around October 5th. We should be down in this region, or maybe September 27th, maybe hit, it looks like, and of course that's all based on the fact that I'm guesstimating where that retracement C point is, but it's pointing out here somewhere into September 1st of October to be down here in the sweet spot if everything and all the probabilities work out and we get our full ABC pattern. All right. So that's where I'd like to be a buyer, down in there. I'll kind of wait and watch Salesforce. There's other opportunities that I'll watch for. I like to buy low, sell high, and that's where I want to be a buyer. Does it mean it can't break and go high and take off and go to the moon from right up here? No, it certainly can. That would be a V recovery. Or it could be a double top. It could come down, come back up, test that previous high, and then tank back down from here. So you just don't know how far it's going to rally back up that B to C zone before it turns and falls. And if it breaks a new high, we throw this whole idea out and we go to the next level and we start counting again. All right. So that's how that works. If you have any questions, let me know, and we'll catch you next time.